Hello guys, and welcome to the Trading Journal for Friday the 13th of November, brought to you by verticalspread.com. My name is David and I am also known as the Spread Doctor. I don't know if many of you are superstitious. I used to be superstitious about Friday the 13th when I was growing up. But these days, I tend to see Friday the 13th the same way I see Santa Claus. And I think the markets also shrugged off the superstition of Friday 13th today. The heat map shows a lovely sea of green, and the rally on Wall Street was a broad-based rally. All the equity indices closed up to the tune of 1% or higher, and the Russell 2000 was the outlier of the day. It closed up more than 2%. The ratio of advancing stocks volume to the declining stocks volume was 3-to-1. So there were 3 times more volume in the stocks that closed higher than the stocks that closed lower. And that ratio might have been even higher if not for NIO, N-I-O. NIO is an EV company, an electric vehicle company, and this stock was brought to my attention earlier this week. I think it was on Tuesday, by a good friend of mine who lives in Australia, and incidentally, he just joined the Vertical Spread community as well. So I'd like to take this opportunity to welcome Colin to the verticalspread.com community. And just to mention an update on our progress so far. So we launched verticalspread.com in April this year, and we are now a global community. And I mean literally, we're a global community in every sense of the word. We now have members in Europe, we have members in Africa, we have members in Asia, and we have members in North America. So that is the entire globe. And I would also like to take this opportunity for a big shout out and a big thank you to Joe and the entire Vertical Spread crew. We make such a great team, and thank you for all your hard work, and let's keep up the good work. And by the way, Colin is a brilliant stock picker. He bought NIO, N-I-O, this stock here. He bought it around $7 earlier this year, and he's now sitting on a 7-bagger. Given where this thing closed today at $44. So he bought it around, where is $7? He bought it around here. Yeah, see it around, it's even lower than that. He bought it, this is 7.5, so he bought it around here. So his return is about 700%, 7-bagger from, this is where he bought it, and this is where it closed today. And when I was speaking with Colin on Tuesday, I couldn't help but notice the steep rise in this stock, and also the fact that earnings are due to come out next week. And at the time, implied volatility was so low. IV is now 37.8. On Tuesday, it was 9.6. IV was 9.6. It's now spiked to, let's call it 38. So I suggested buying some protection ahead of earnings to lock in some profits, just in case the stock fell off the cliff after earnings. And with IV so low at 9.6 at the time, puts were very cheap, and that was precisely what he did. So I just want to touch on hedging a bit today. For anyone holding a stock position with some decent gains, you can protect your downside ahead of earnings or ahead of any binary event or any general volatility by buying some out of the money puts for whatever time frame you want protection for. And the thing to note mainly is IV. I would suggest only buying puts, straight puts, when IV is very low, say IV below 30. If IV is higher than 30 or say 40, 50, and you want to buy protection, instead of buying a straight put, I would suggest buying a vertical spread. So that would be a debit spread. And the short put in the vertical spread would mitigate some of the theta decay on the long put. So if you buy a straight put when IV is really high, the theta burn rate will be significant, so that even if the stock was to go down, the theta could override the delta gain. Without complicating it, bottom line is, if you want to buy straight puts, buy them when IV is low. If you want to protect the downside and IV is high, I would suggest opting for a vertical debit spread instead. And in terms of how many puts you need to buy to hedge your position, just bear in mind that one options contract is equivalent to 100 shares. So if you're holding less than 100 shares and you want to hedge, one contract would suffice. Also note that you can either over hedge or under hedge, and you might not always be able to get a perfect hedge. For illustration purposes, say you have a long position of 220 shares in NIO. Say you have 220 shares, 220 NIO shares. You can buy, and let's assume implied volatility is low at this point, you can buy two put contracts, and that will hedge you for 200 shares, which means you'll be under hedged. Or you can buy three puts, and that will hedge you for 300 shares, and in that case you would be over hedged. So just thought to cover some sort of hedging for those who are holding stock positions and want to lock in some profits ahead of some major events or just some general market volatility. Moving on to the VIX, and the volatility crush that started after the US elections continues. The VIX dropped about 9% today to close at 23.1. It is still holding onto the crucial 20 level, and that continues to bode well for premium selling strategies like my credit spreads. Moving on to new trade ideas, I had no new trade ideas today, but my last position in the November contract, which was a position in SLV, closed out today. This one here, this position closed out today. It hit my profit target and the position is now closed. I also had a new trade idea in BABA yesterday, Alibaba. For more information on those two positions, you can visit the Trade Ideas forum, and I'll also drop the links to those two positions below this recording. There are now 7 days until the November contract expires, and there are 35 days until the December contract expires. And given that my SLV position closed out today and freed up some buying power, I'll be looking for more spreads to sell in the December contract next week. I no longer have any open positions in November, like I said, and I now have 3 open positions in the December contract, and I'll review those positions now. So if I go to December, actually before I move on to December contracts, November, so all my November positions are closed, and by all I mean all 2 of them. I only had 2 positions for the November contract, and you recall November is the election month and there were many companies announcing earnings. So those 2 factors meant I was unable to find many opportunities that met my criteria. But I still managed to find 2 trade ideas and hit my profit target on both trade ideas, and we made money on both of them in spite of the election jitters in the market. So I didn't get many trade ideas, but we still got 2 positions and both of them made money, and that's how these things happen sometimes. Some months you get 4, some you get 3, but we tend to average about 3 trade ideas a month. Now moving on to the December contract. I have 3 open positions in December in ARKK, BABA, and MRNA. Starting with ARKK, I opened this position on the 4th of November. I sold the 91.86 put spread in ARKK, and I got a credit of $1.30. Let's see where this thing closed today. So ARKK closed at 99.4. I'm short the 91 put, which means my short put is out of the money. And this week is the end of week 1 for ARKK. I opened this position last week, so let me check what my P&L is for ARKK. I'm going to go to my portfolio tab. ARKK is showing a gain of 250, so that's my, this is my open P&L. That's the P&L for today. So my total open P&L is $250 or $50 per contract. I've got 5 contracts, so $50 per contract. My short strike is out of the money, like I said, so no action is required on this position. The second position I have is in BABA, Alibaba. On this one, I sold the 250-245 put spread for a credit of $1.50. Let's see where BABA closed today. BABA closed at 260.84. I'm short the 250 put, so my short put is $10 out of the money. Now, this position was only opened this week, a few days ago, so the end of week 1 would be next week, and I will review this P&L. I'll review the P&L for this position at the end of next week. But for the time being, no action is required. My short strike is out of the money. And the third and final position is in mRNA, Moderna. On this one, I sold the 75.70 put spread for a credit of $1.60. Let's see where mRNA closed today. mRNA closed at $89.39. My 75 put is about $14 out of the money. No action required on this position, and this position was opened only 2 days ago. So the end of week 1 for this position is also going to be next week Friday, and I will cover the I'll review the P&L then. That leads me on to my watch list for this week, and on my watch list I have got ARKK, BABA, PDD, QDEL, and UNG, and I'll quickly go through them. But it's the same theme every time I look at this watch list. It's mainly because implied volatility on these underliers is high. So starting with ARKK, BABA, PDD. ARKK is trading at a close at 99.40. Implied volatility is 53.8. Let's call it 54. And that's why that hit my radar. The second one was BABA, Alibaba. Alibaba has been in the news a lot lately. Jack Ma, he's having troubles with the Communist Party, so I think they're trying to tell him who is boss. Anyway, this stock closed at 260, IV 55.3, and that's why that is still on my radar. Third one is PDD. We had a position in this earlier in the year. Might be able to do something in this one next week. No earnings announcement, no binary event I'm aware of. I might need to look into that to find out why volatility spiked in this one. But $151 stock, implied volatility 71%, and that's why that hit my radar. QDEL, $198 stock. This is a pharmaceutical company. IV 52.4. IV was much higher earlier in the week, about 80, and the main reason why I didn't put on a position in this stock is because there's the IV spiked because of a binary event. So I believe some announcement is imminent. The announcement is due end of November. It's a pharmaceutical company. They're going to announce the result of the drug trial at the end of this month. So I don't want to hold a position going into that announcement. And finally, UNG, which is a natural gas ETF. This one 1132, implied volatility 55, and this one I actually did want to put on a position earlier in the week, but because it's such a low priced stock, 11, I couldn't do a $5 widespread, so I was looking at a $1 widespread. The credit was quite decent. It was about 20. I think I would have been able to get about 27 or 28, but the allocation, my position allocation for a $1 widespread would have been 33 contracts. When I looked at the round trip commission on 33 contracts, it was ridiculous. It was close to $100, I think, or maybe it was $80. It was too high anyway. You know, in a $5 widespread, you're looking at a round trip come of $15-20 maybe, or even less. But you know, $100 commission, it's just not worth it. So that was why I didn't put on a position in UNG. And that brings me to the end of my journal for today. The main highlights for today: all my positions in the November contract are now closed, and I hope to get more trade ideas for the Christmas season. We're all going to be celebrating Christmas alone if we follow the advice being given by the health professionals. So maybe I can give you a position to keep you company over Christmas. I hope you enjoyed listening to my journal today, and to those of you watching on YouTube, on our YouTube channel, you're more than welcome to join our ever-growing community. Whether you're a successful stock picker or a swing trader or a futures trader, you can diversify your portfolio or your trading activity by adding a passive income element delivered by trading option credit spreads. So why don't you click on the link below and take advantage of the free trial and just see if it's for you. And you know, you never know, you might like it or you might not, but you'd never know unless you try. So click on the link and take advantage of the free trial. You can leave me any questions or comments below, and have a fantastic weekend. I shall see you next week. Goodbye.